Today's topic will be on credit. Prior to the pandemic, the United States was in one of the best economic times of our history. Unemployment was lower than it's been in over 50 years, and more Americans were working than at any other time. Yet, despite our nation's prosperity, over 75% of us were living paycheck to paycheck. I don't believe this has to be the case. By taking the time to engage and understand the topic of personal finance, we can avoid being a part of this very unfortunate statistic. So, what will I be talking about today? Understanding what credit is and how it works and why you need it, understand the different ways of establishing credit, learn your responsibilities as a borrower, understand how to monitor credit using a credit report and credit score, understand loans and credit cards, and how to borrow responsibly. Credit is the ability to borrow money or obtain goods by paying little or no money at the time of purchase and then paying back the money by making payments over time. Institutions, like banks, lend money to earn interest. Leveraging credit means to use borrowed money for an investment, expecting that the value gained in the future will be greater than the interest paid. In this illustration, a person is working to gain prosperity by utilizing debt. This can be done well, and it can be done badly. On average, people earn over $1 million more in their lifetime with a college degree than with just a high school education. For example, a person may take on debt to obtain a four-year degree to access $1 million more in greater prosperity. In the example of education, it is important to borrow wisely. No one should take out more education debt in total than they expect to earn in their first year working after completing their education. For example, social workers start at approximately $32,000 a year. So if a person was utilizing debt to gain their education to be a social worker, they would not want to be more than $32,000 in debt overall. If they keep their total debt below their starting salary, they should be able to pay their student loan debt off in 10 years. Another example of using credit to enhance a person's life is to purchase a home. It's important that the loan payments for the house are a part of a very thoughtful budget. Think of this slide broken in two parts. On one side, you have a revolving and installment loans, which are a type of credit, and on the other side, secured and unsecured loans. Let's talk about revolving loans first. This is a loan that is not on any scheduled payment plan. For example, credit cards. Installment loans are paid off in a scheduled manner. For example, student loans usually have a 10-year scheduled payment program, while homes are usually purchased over a 30-year scheduled time frame. On the other side of the side is secured and unsecured loans. Secured loans means that if you do not keep up on your scheduled payments, they would have something to take back. For example, if you don't continue to make your car payments, they could eventually take that car back from you. This is also the way it is with a home loan. If you're not staying up on your payments, you could lose your home. Unsecured loans are simply debt that they don't have anything to take back from you if you fall behind and are unable to make your payments. An example of unsecured loans is credit cards. If you do not pay your credit card minimum payments, though it will greatly damage your credit score, there isn't anything that the credit card company will take away from you if you fall behind on your minimum payments. Why do you need credit? It comes into play for a lot of reasons, as it is indicative of your reputation with handling money. You'll hear the question, how is your credit? And this now takes on a secondary meaning. This question means, how is your reputation for handling money? And it can impact your ability to access any of the items on the screen. In a moment, we will discuss how your credit score is the key indicator as to your ability to wisely manage credit. Your responsibility as a borrower is to borrow only what you can repay. Make sure the credit payments are included in your budget. Read and understand the credit contract. Pay debts promptly. This is so critical. Hopefully you won't fall into item number 4, but if you struggle and can't meet your payments, quickly notify your creditors and let them know your situation. They may be able to assist you by temporarily adjusting your payment schedule. It's very important to report lost or stolen credit cards promptly. If you do, you won't end up losing any money, as a credit card company will take the liability for the loss. They are willing to absorb the loss because they want you to continue using their credit card. Let's discuss credit cards in more detail. Usually you will start using a credit card when you get your first full-time job. In reference to using your credit card, only charge something on your credit card that is a part of your planned budget. It's important to pay the full balance on time each month. If you do that, you'll pay no interest on the usage of your credit card. Be clear in your understanding that credit card interest is usually very high, on average 17 to 20%. Concerning maintaining the credit card, my thought is to have one credit card with you at all times to use and then have a backup credit card that you keep at home so that when your credit card number gets stolen, and yes, it is a common occurrence, you'll be able to have another credit card to use while you wait for your new credit card to come. Many times it takes up to 2 weeks to get a new credit card, and you don't want to be inconvenienced by not having one. In reference to finding the right card, I would recommend finding a card that has no annual fee. Many cards can charge anywhere from $80 to $400 annually, but ideally you should start with a credit card that has no annual fee. Also, find a credit card that has benefits that are aligned with your lifestyle. There are credit cards that will pay you 1% to 2% back in cash for every item that you charge on the card. They're able to afford this because 40% of Americans, unfortunately, maintain an average of $15,000 at all times on their credit cards, paying 20% annually on that $15,000 or $3,000 in interest per year. You do not want to be one of those people. Accordingly, once again, you want to pay your credit card bills off on time in full each month. If you do, you won't pay any interest on your credit card usage. This is an example of what happens when someone only pays the minimum on their credit card bill. So be clear, the average minimum monthly required payment is only 4% of the balance. In this case, for a $2,500 balance, the minimum required payment is only $100 per month. But as you can see, if someone pays only the minimum, it would take them over 7 years to pay the entire $2,500. And in that time frame, they would pay an additional $1,289 in interest. In the other two cases, if the person pays $50 more or $100 more per month beyond the $100 minimum required, they can greatly reduce the amount of time it takes them to pay the entire credit card balance and pay less interest. The range of credit scores are from 300 to 850. You can get your credit score up in the 700s pretty quickly if you conduct yourself well in the following areas. 35% of your score is based on just paying your bills on time. The second most significant impact on your credit score is called balance to limit ratio, which is 30% of your score. The balance is the amount you charge on your credit card, and the limit is the amount you could charge on your credit card. Ideally, on average, you should not be utilizing any more than 30% of your balance to limit ratio. For example, if the limit on your credit card, the maximum amount you could charge, is $1,000, then ideally you should not be charging more than $300 on average per month. At some point, you want to charge more on your credit card, and when that happens, you can call your credit card company and ask if they will increase your limit. For example, you start to charge up to $1,000 a month, you can ask your credit card company to raise your limit to $4,000 a month, and then your balance to limit ratio would be 1,000 divided by 4,000, or 25%, nicely below the target 30% balance to limit ratio ideal. The following are some examples of how certain actions can impact your credit score. If you max out your credit card, meaning charging as much as you can each month, even if you pay the bill off in full, it can hurt your credit rating 25 to 45 points. If you file bankruptcy, your credit rating will be devastated and it will make it very difficult to borrow money for the foreseeable future. Your credit score also impacts how much it costs to borrow money. The better your credit score, the lower your interest rates will be, and you'll pay less in interest on a loan. Important takeaways for today. Only utilize credit when it can be a part of a thoughtful budget. Make sure you pay as agreed to in the terms of the credit contract. Avoid missing payments. Be strategic in how you utilize credit to enhance your life. For example, if you have to borrow money for school, make sure that it takes you no more than 10 years to pay off your student loans. When they're entirely paid off, then you may be in a good position to possibly purchase a house. And finally, quite possibly the most important specific thing I can recommend to you is only charge on your credit card that of which you can pay back in full on time each month. If you conduct yourself in this manner, you'll pay no interest and you'll be on the way to establishing a very good credit score.